Pioneer Natural Resources, ticker symbol PXD from New York Stock Exchange, is a top-tier explorer and producer of oil, natural gas, and natural gas liquid. They are one of the largest oil drillers with a market cap of $57.8 billion with over 869,000 acres of operating fields, 5,300 wells, and 16 rigs. They are considered to be a high-yield dividend stock, which may not appear on the headlines of news sources like Tesla or meme stocks, but considering the current situation of extreme inflation and economic instability, these established dividend stocks provide a viable investment alternative to protect your money against the volatility that growth stocks and crypto often face. So, what has changed, and why is now the perfect time to invest in high dividend stocks, especially PXD? In recent years, investors have seen their portfolios face a decline of more than 30%, seen it all recover, and enjoy a massive bull run until early 2022, which then resulted in another 22% drop again, all owing to factors like the COVID lockdowns, quantitative tightening by the Federal Reserve, and hyperinflation at 9.1%. Times have never been so volatile, and the one aspect that long-term investors despise is an unstable cash inflow. The Consumer Confidence Index has fallen to a historic low, and people are now looking to reduce their exposure to the extreme volatility of the market right now. Yet high-yield dividend stocks seem to be the perfect solution against the problem, as they tend to be cash-rich. Mature companies in sectors like energy, utility, and finance tend to be less affected by unpredictability in the market. This is because the products and services they offer tend to be a necessity within people's everyday lives, where even during an economic downturn, everyone will still regularly purchase these items. When you're short on cash, you're less likely to purchase the newest model of iPhone, but you still need toilet paper no matter what. These companies are considered non-cyclic, which include corporations such as Procter & Gamble, Kraft Heinz Company, and Nucor. The stocks of these companies ensure predictable cash flows, less fluctuation in their stock prices, and high chances of capital gains, which makes them the perfect hedge in a rising interest rate environment with a recession looming around the corner. PXD resides in the oil and gas industry, and oil is an absolute necessity in today's world that requires adequate energy to power things such as lights, cars, and heat your home. Even if the current economic downturn continues to play out, the global demand for oil will likely remain unaffected. PXD drills all of its oil in the Permian Basin, an area residing between Texas and New Mexico, and holds a monopoly there. There's an estimated 105.7 billion barrels of oil left to be unearthed there, and an amount enough to power the current US consumption for 200 years. With crude oil price currently at $89.75 per barrel, this amounts to nearly $9.5 trillion in potential revenue. It is of course unrealistic to assume they'll be able to mine all of it. However, this likely means PXD will not run into any supply issues anytime soon. Mentioned in the annual report of fiscal year 2021, the company's long-term strategy to enhance shareholder value is to maintain a strong balance sheet and financial flexibility, return free cash flow to shareholders through a stable and growing base dividend and buybacks, technological advancements to reduce costs and improve efficiency, deliver economic production through drilling and production improvement activities, and focus on high environmental, social, and governmental standards. However, the best part about PXD is that it provides the quality long-term investors care about the most: steady cash flows. Pioneer has made roughly $24 billion in revenue this year and has an operating margin of more than 40%, with a 5-year PEG ratio of only 0.7. The company also distributes the highest percentage of free cash flow in its industry at 80%, which means that they are willing to allocate 80% of available cash flow to pay creditors and dividends to shareholders. In addition, with PXD having a low debt-to-equity ratio, more than 30% revenue compound annual growth rate in the last 5 years, a dividend yield greater than 10%, and bullish sentiment from broker analysts, PXD has consistently maintained healthy track records and conditions needed to give investors adequate insurance on their money. PXD investors are thus in a comfortable position to benefit from double-digit dividend yields and a steady stock price growth. the massive surge in energy stocks since 2020, and with the global oil supply issues, the commodity's price will continue to remain elevated in a long-term basis. The fundamental strength of the stocks and industry makes the PXD very attractive and all set to distribute high dividends. In their 2021 annual presentation, PXD has continued denoting their strong inclination to continue returning value to their shareholders. As you can see, PXD's nearest competitor is only willing to distribute less than 60% of their total free cash flow towards shareholders. PXD's generous 80% allocation indicates their intentions to regularly provide holders with dividend payments and potentially see dividend increases in the future. Additionally, the Q2 2022 results update shows a real positive outlook from management. Management expects oil sector fundamentals to increase and aims to continue rewarding shareholders through dividends, share repurchases, and predicts steady growth ahead. Dividends in total returned roughly 15% annually and will continue to be the largest part of the shareholder return structure. Share repurchases and buybacks have increased to $500 million in Q2 of 2022 from $250 million in Q1 of 2022, and plans to continue to deliver a strong level of repurchases. Maintains a strong balance sheet with cash on hand at the end of Q2 of 2022 netting $2.6 billion and a net debt of $3.1 billion. Increased capital expenditure spent from $3.6 to $3.8 billion due to high inflation. Board of Directors declared a quarterly dividend of $8.57 per share, comprised of a $1.10 base dividend and $7.47 variable dividend. Dividend included a greater than 40% increase to the base dividend and represented a total annualized dividend yield of approximately 15%. In regards to their ESG plans, the company has multiple initiatives underway that are expected to result in tangible progress towards their net zero emissions ambition. The company's financial position, industry tailwinds, and management's long-term strategy makes it the ideal long-term investment to park your money and enjoy regular dividends in this volatile and challenging environment. With the rise of electric vehicles and Tesla, come check out why lithium companies are one of the best industries to invest in right now. Please consider liking and subscribing if you enjoyed this video.